Hello everybody, welcome to our webinar series. Pretty happy to have all you with us today. My name is Merlin Rothfeld and we are going to talk about a topic that may not be near and dear to your heart at this present moment because we really haven't seen much of a decline in these financial markets, but going forward it could be a major portion of a problem for some people. And many of you might have encountered this problem back in 2008 when we had our big market collapse there, or going back even further, say into 2000 and 2002, there was some pretty significant market sell-off. So the question always becomes, it always seems to come in right as these markets are in a free fall. People are panicking, they're screaming, and you look at your coworkers like, oh my God, my portfolio is dying. It should never be that way. It should all be planned, thought out, and therefore we have an actionable plan so when the markets do crash, there is nothing to really worry about. So we're going to talk today about what to do if the markets crash. And I should actually change this. Because let's be honest, it's not a question of if the markets will crash. I think that we could all agree, and if you disagree with me, please type it in chat. I'd love to hear your reasons why. But it's not a question of if the markets will crash. It's simply a question of when. They will crash. There will be a 30, 40, 50% correction at some point in time. That I can guarantee you. Now, that doesn't necessarily mean that this current rally is going to drop 50%, but in the future, we certainly will have some big market corrections of 30, 40, 50%, maybe even bigger, who knows. Bottom line is when that happens, what should we do to protect ourselves? So let's dive into our presentation out here today. Here's a disclaimer for everybody, just so we kind of are on the same page. I'm not going to be giving specific advice here. I'm going to just give you kind of an overview of the different ways that we can access these markets in a downturn and what we could be doing for our portfolio. So it's not, I won't be giving you any actionable trade setups here or anything like that. Bottom line is, what do we do? Again, a lot of people panic. They start to freak out. They don't know what to do, and that's just because they're unprepared. Now, one of the things we focus on Online Trading Academy is really saying, look, let's be prepared for any market situation. Let's be prepared for no matter what happens out there, whether the markets go up, they go down, or they go sideways. And that's the only three things that we know for certain are going to happen in a market. They're going to go up, markets are going to go down, and many times markets will go sideways. The key is that our portfolio, when that happens, shouldn't have those three options, right? Our portfolio shouldn't go up, down, or sideways. Our portfolio should go up or sideways, and we should remove the down. If we can remove that down part or dampen the down, then all those up moves become much more significant, and that's how we grow our wealth and we accumulate a lot of capital. So let's take a look historically here at our financial markets, just to set the stage of where we are. And of course, this goes all the way back into 1996. You see the end of a wonderful bull rally all the way up to 2000. Then we had a nice market sell-off, another rally, big sell-off. But let's put it in perspective by putting some numbers on here. Now, most people are excited and ecstatic about getting these kinds of market returns. I was actually at dinner last night and was listening to a gentleman talk about an industry professional who has been gloating about how amazing his returns have been since 2010. Really? It's moved 315%. A blind squirrel can have great returns from 2010. It's not like there's anything really special about that. The key is when you have big market sell-offs, how is your rate of return? And notice that here from 2000 to 2003, the markets dropped 51%. Here from 2007 to 2009, we saw it drop 57%. Now, I would ask you all in your minds, do you think we're going to see something like that here going forward? Do you think we're going to see maybe doesn't have to be, let's just call it 50. If we drop 50% from that all-time high there at 2713, that would put us down around the 1350 mark, well, which would be right about, let's cursor on that one, right about here on your screen. I don't think that that would be outlandish or out of probability. It could happen. There's a lot of factors that have spurred this big market rally up. There might be a lot of reasons that could spur it to the downside. So we should be prepared. Now, when it comes to how do we make money or what do we do if the markets crash, I think it really boils down to three simple things. What is your objective? And that objective is going to be, in my opinion, one of three things. If you feel like there's a different option out there, feel free to send it in our chat. I'd love to hear from you. But number one is going to be preserve capital, meaning I don't want my account to go down. I think that should be step number one, is I want to make sure that my account doesn't decline in value. You've got some phenomenal gains since 2009. You should lock those in. Or your goal could be that you're very bullish on this market still, and you feel that a sell-off coming in the market, whether it's 20, 30%, is a buying opportunity. Great. That's another alternative. The other part here is to capitalize on that sell-off, meaning going short by various means and making money as these assets fall in value. So let's start with the first one here, which is preserve capital. There are a lot of different ways that we can do this, and most people, like I say, have amassed wealth that they want to maintain. And nobody wants to lose 50% of their capital. Unfortunately, what happened for retirees in 2000 and in 2008 is many of them did lose 50%. Now, of course, in hindsight, we can look at those that they were holding long. Let's say, for example, you have a relative or yourselves were retiring right around 2007. So you retire, things are looking great, markets are fantastic, and all of a sudden it starts to slide. Now your account went down 50%, maybe even more depending on the mutual funds and the mutual fund fees that you're in. Well, as of today, you're probably thinking, that was no big deal. It's okay. Well, the bottom line was you had to wait about 7 years to get back to break even. Now keep in mind, if you're a retiree, during that 7 years, what's been happening? You've been actually taking withdrawals from your 401k, which is now 50% less. And now all of a sudden you're saying, oh, well, it's back up to even 7 years later, but it's not with the same amount of capital. It's been utilized, a lot of that capital. So what we don't want to do is have to ride out these major market downturns. So preservation of capital is going to be key, not only for the retirees, but even for people like myself. I don't want to take steps backwards. I'm okay with one step back, but I'm not taking 30 or 40 steps back. That's taking me years to accumulate. So the first step in preserving your capital is simply to go to cash, right? This is the easy one. Go to cash. Now, here are some of the pros for this. Number one, you're not subject to market fluctuations. You have cash physical in your hands. You don't have to worry about, the market fluctuation. The market drops 50%, oh well. Now, certainly there might be some devaluation of the dollar. That's a separate situation, but your dollar will have its value. And most importantly, you are in control. Now, this isn't all roses. There's cons to this, and the cons are that it's losing value. And what we mean by losing value is there's an ever-present thing out there called inflation. Now, occasionally we do hit pockets of what are called deflation, but for the most part, we're looking at an inflationary environment. Not only that, but the Fed has targeted 3% inflation. Now, currently, we are at, as of this moment today, 2.2% inflation. What does that mean? That means that at the end of the year, the purchasing power of your dollars will drop by 2.2%. So while we say going to cash is the safe way because you're in control of it, you have physical control of all that money, you actually will be losing money. Now, it's only 2.2%. Granted, if the market drops 50%, you're probably feeling pretty good about yourself. But there are ways we can improve that rate of return and maybe accommodate for the increasing inflation rate. The other part here is storage risk. That's a major problem with this. Most people probably don't have a safe that looks like this in their house. Well, if you got a bunch of cash, especially if you're looking at $50,000, $100,000, $200,000, $500,000, you're probably going to want to have a safe like this. So these are some of the bad parts to going to cash. That's certainly not what I would recommend, but hey, that's kind of a knee-jerk safety reaction. You can pull your money out of the markets, lock it in, put it in cash. Next step here is going to be certificates of deposits. Now, there are many, many choices, and I'll probably blow you guys away here in a second when we look at some of the different considerations with certificates of deposits. But really all this is a short-term contract where you're depositing money with a financial institution for a set period of time. And here are some of the key considerations we need to look at with certificates of deposit. Number one is duration. How long do you plan on keeping your money there? Is it 3 months? Is it 6 months? Is it a year? Is it 5 years? Your rates of return, the ROR, will differentiate based on how long you keep it there. Also, the deposit amount. Some have minimums, some have very high minimums, and then you also have fees. There's early withdrawal fees, sometimes there are administration fees, and as we've learned with different asset classes and instruments, they will kill you with the fees. So let's take a look at some of the different types of CDs. Now, I want everybody in their mind to think, or you can type into the chat, the different types of CDs that you can think of. Now, most of us are thinking of one, right? You put your money in for X amount of time, I get X amount of rate of return, and that's it, right? Shouldn't there only be one? Well, take a look at all these options out here. It's ridiculous. Traditional CDs, variable rate, bump up, no penalty, brokered, callable, jumbo, ladders, barbells, bullets, and there are more than this. So it really is important that if you do decide to go in the CD route, to do your due diligence, because they not only are there a lot of different structures for each of these, but they are very, very different rates from firm to firm. Now, to drive home this point, let's take a look at some rates. One solid piece that Online Trading Academy and myself will give you, and OT Academy, is shop around. Please do not go to your local bank and take it as face value that they've got the best rates. Shop around, just like you go when you buy a car or you're going to go buy yourself some new shoes. Shop around. Now, these rates are unbelievably different. I was kind of mind-boggling looking at some of these rates that these banks are offering. I'll start down here at the bottom with two that you know very well. Wells Fargo and Bank of America, formerly known as the Bank of Italy, by the way. Look at the bottom one, Bank of America. So you could start a CD with them for any amount, but if you put in there for 12 months, they're going to give you 0.05%. I'm just remaining silent for dramatic effect here. 0.05? Really? I could probably put it on my windowsill and water it and get more rate of return than that. What does that mean? If you put in $10,000 into a Bank of America CD for 12 months, at the end of year one, you made $5. Wow. Thanks, Bank of America, for really securing my financial future. But wait, if you keep it there for 60 months, you get 0.75%. Wells Fargo gets you up to 1%. So this is why I said shop around. Look at some of these other firms. Goldman Sachs has a program called Marcus. And Marcus, if you keep it there for just 12 months, will give you 1.65%. That's a full 1.6% more than Bank of America. Now, if you keep it there for 5 years, you make 2.4%. So importance if you're shopping around. Now, one thing I want to make clear is if you put it in there for 1 year at 1.65%, remember, you're still losing money. It's safer, but you're still losing money. Why? Because inflation is 2.2%, which means you're losing about 0.55%. So while this is a slight step up from going to cash, remember it's probably going to be a bit safer. These are going to, and make sure you only do it with FDIC-insured financial institutions. That is a big one there. But you're still technically losing money because of time and inflation out there. Now, inflation could drop and could rise, so that might change these numbers, but I was just giving an example of where to park your money if things start to drop. Now, let's go one step further. Let's talk about the risk-free rate. It's risk-free, people. Yeah, I'm going to do the Barry Bonds thing and put a little asterisk on this guy. There is no risk-free, people. Nothing in the financial markets is risk-free. And that asterisk simply, I had to put it there because I hate when people say treasuries are risk-free. They are not risk-free. Remember, the risk there is that your government defaults. Now, what are the odds of our government defaulting? Very, very slim, but it could happen, as they said in Dumb and Dumber. So you're saying there's a chance. So it's not risk-free, but it does provide a little bit of a step up maybe that from a CD. So let's talk about some of the different structures there with regards to treasuries. There we go. Now there's really kind of four that you want to focus on here, and it all comes down to time and duration. Treasury bills are certainly things that are less than 1 year maturity. So if you're looking at a 6-month, a 3-month, that's going to be a treasury bill. Treasury notes are generally ones that run from 1 to 10 year maturity. Treasury bonds are more than 10 years, and then there's also one that is called they're called TIPS, which is Treasury Inflation Protected Securities, which out of all of these, I kind of like the best. So I'll real quickly give you an example. So you could buy let's call it a 1 year Treasury bill that's going to get you 2.09%. But in the course of that 1 year, inflation really spikes. And you see some major moves up in inflation. All of a sudden, it jumps from 2.2% to 4.2%, and by the end of the year, it's 6.2%. Massive increase, right? Which, when we've been printing money as long as we have, there is that chance. So what happens to that Treasury bill? Well, you're still getting your 2% because that's what you locked in at. So you're technically now losing money. With the TIPS, what it does is it adjusts, and it adjusts to the current rate of inflation. So if inflation were to spike up, your TIPS would be adjusted for that inflation rate. Therefore, you wouldn't be losing money because of inflation, which is a very nice feature. And remember, one of the big things that the markets are worried about right now is the potential for hyperinflation. Remember, what's been causing this market rally since 2009 has been cheap money. We've had rates at zero for the longest time, meaning banks and financial institutions, including you and me, can go out there and borrow at historically low rates. That is creation of new capital, and therefore you have more money chasing the same amount of goods and services. This is what drives inflation. So it could rear its ugly head. Not saying it is, but there is that potential, and given the fact we've been printing with quantitative easing 1, 2, 3, Operation Twist, and many others, that possibility grows exponentially. Now, here are the current rates of return as of yesterday for these different treasuries. Now, really, 1 year, you're looking about 2.09%, 2 years, 2.28%, 5 years, 2.6%, and 10 years, 2.79%. Now, notice some of these are slightly higher than that 2.2% inflation number I've been quoting you. So there is the security of knowing that you're beating inflation. But remember, inflation could rise in the next 2 years or 5 years or 10 years. So these numbers could change significantly. Now, treasuries are a great way to go about and kind of protect your portfolio out there. You could go out to your broker dealers and get it, but I would recommend going to Treasury Direct. This is straight to the government, and you can buy and sell them right there. You can see on the left-hand side near the bottom, you see treasury bills, notes, bonds, tips, and FRNs. There's a lot of different asset classes out there that they offer, but you buy direct and you cut out the middleman. And of course, we know when we cut out the middleman, everything seems to get better. Okay, let's move on from treasuries and go from the preservation of capital. And by the way, folks, remember, this is essentially what an annuity is doing, is they are buying treasuries or they're buying instruments and using options to preserve your capital. And the thing I want to shy most viewers away from annuity is the fees. So annuity, some structures out there are great at saying you're going to suffer no market losses, but you get to participate in some of the market gains. Not all of it, but some of it. Well, we can do the same thing through a combination of what we're going to talk about here today. So let's look at the next one. Yeah, Catman says, I bet the fees will eat any of the interest. Probably, especially with the Bank of America and Wells Fargo ones. I'm just going, A, you're not offering me anything, and B, you have all these fees associated with it. It's terrible. Shop around. Okay, so we move away from option number one, which was let's preserve capital, which is paramount. Let's make sure we do that. To now, let's buy these pullbacks. There are many people out there that feel these markets are robust and still very strong, albeit due for a correction. So they're not bearish. They just want to wait for a buying opportunity. Great. So let's look at some examples out here. Now, what we want to do is make sure we use core strategy, which is taught Online Trading Academy, to find zones where we feel there's a high probability of price bouncing. Now, we've got one right here on the chart, right around that 20, looks like it'd be about 2,500. You can see one down here right around 22. We've got some way down here around 1,400. And there are others. I just kind of cherry pick some of the big, overwhelming ones that I see jump off the chart. So what we could do is, obviously, if we were waiting for things to come down to those levels, well, we would simply open up our order entry window, we would type in the amount of shares we want to buy at those specific levels, and then we would put limit order, and most importantly, make sure you change it to good till cancel, GTC. That means that order will stay in your broker-dealer system until that trade gets executed or you cancel it. So that's one way you can do it, but honestly, is this the right way to do it? I don't think so. I think if you're going to sit there and wait for this market to drop, the S&P in particular, to drop to 2,200 before you start buying, you're wasting time, right? We're at 2,600 and you want it to drop to 2,200 before you buy? That's 400 S&P points. That is a massive amount of money that could be made. And if you're just sitting there waiting for it, you're losing it. So what could we do to augment this strategy of buying that dip? And I'm going to use the example of buying the S&P at 2,200. Not saying that that's where we need to buy it. I'm just saying as an example here so I can show you with some different strategies. So let's take a look at how we could modify this from putting a limit order to buy at 220 on the SPY and just waiting, which is just a waste of time, to using an option strategy. So here we have an options chain. And all I did is pull up the options chain for the S&P. And what we're going to look for is saying, at 220, I'd like to buy the SPY. That is the equivalent of 2,200 on the S&P 500. So here we are looking at the options chain saying, all right, what are the puts and calls out there for these specific options for me to buy 220? So I'm looking at the 220 price. You guys can see a little highlighted box going to pop up here for you in a second. There you go. Now, in this one, that's right, Steve on our chat says it right away, sell puts. And that's what we're going to do here. This example is looking at selling puts. So you can see right there on the yellow box, there's 220 on the left side of it, and then in the middle it says 351. On the right-hand side it says 355. That's the bid and the ask. Those are the prices that people are willing to buy and sell puts at. So what I want to do is I want to sell puts. So I'm going to sell a put. Now, the length of that put, the duration of it, is totally up to you. I chose the September 21st ones here, which is going to give me about 5 months of time. But By the time you guys see this webinar, it could be 6 months later. So you need to look, I generally like to go out several months and give myself a little bit of time for that option contract to pay out. Now, if we were to sell the September 21st, 2018 220 put, I would be collecting myself $3.55. Now that is per share, right? So there's this expiration September 18th. I collect $3.55 per share. Since each options contract is 100 shares, I am putting $355 in my pocket. Now I'm doing the exact same thing as I did in the previous example. I'm still waiting for it to get to 220. If it gets to 220, okay, I'm going to buy it. If it doesn't, I've collected $355 simply for waiting. Thank you for paying me for sitting on my hands, where I know a lot of people are looking at this market saying, hey, I'm just going to put a limit order down at 220 on the SPY and wait. Don't do that. Collect some premium along the way. Now, here's how it would pan out visually. If we look at that chart again, you guys can see here we've got the 220 mapped out on the right-hand side, okay? If that's our demand zone, right? We've done the analysis, we've used our odds enhancers, and that we feel like that's the strongest place that'll support it, and we feel like this uptrend's still intact, great. All I care about is that green box. And what that green box means is if price stays above that or stays in that green box or anything higher, let's say the S&P 500 moves to $50,000. Well, it doesn't matter. I'm still collecting my $3.55, okay? So the only thing that could happen here is I am going to collect my $3.55 or I get executed. Now let's show you the outcome of this. All right, so here's what I was trying to explain. If you want to buy the dips, you can wait for price using just the stock or the ETF here. Waiting for price to hit 220, you may never get filled, right? It may never come down to 220 ever again. Who knows? If it does, well, you're going to get filled at 220, and that's where you're going to be long from. It's going to cost you $220 per share. But what if we used options? If we sold those puts, I'm immediately collecting $355 up front. I'm going to be clear to everybody, that number 355 changes depending on the time frame, the time of day, the expiration, the strike price. So you may not get 355. It depends on the options contract. We're still waiting for price to hit 220. We still may never get filled, and if it never gets filled, well, we keep that $355. If it does drop all the way down to 220, and we are put those shares, meaning we'd have to buy those shares at 220, what that essentially does is make our average cost $216.45. Now you're thinking, well, how did you come up with that, Merlin? It's basically taking 220 and subtracting $3.55 per share. Therefore, $216.45. So that is, to me, a great way, one that I think most people should be utilizing. If you feel like this market is headed for a big drop, find a level that you're happy to buy at that's much, much lower and potentially buy into that point. Use the options to collect premium. Now let me read a couple questions here. Ivan says, Merlin, are you one of those people that feel long-term bullish? Look, if you don't feel long-term bullish, you don't understand how the markets work. You have to feel long-term bullish. Why? Because the markets are constructed to be bullish. Think of it like your favorite football team, right? I'm a 49ers fan. Don't hate me. I know my team's been in misery for years. But in any football team, what they'll do is if a player's underperforming, they boot him and they draft, they find somebody, they'll buy him from another team, a better player to fit that position. They want the best player in there at all times. The S&P 500 is exactly the same. It's got 503 stocks now. It used to be 500, but now they made 503. And what they'll do is periodically they will replace the underperformers with better performers. So your bias has to be long-term long. Do I feel that we are overextended? Absolutely. Just look at the chart. Historically, we have never had anything like this. So I don't know when the crash is coming. I just hope that when it does happen that I am ready. But I would say long-term, I am bullish on the markets, just not right now. I'm not thinking about buying these markets right now. I'm more inclined to think about being proactive and maybe going short or preserving capital now versus waiting for the market to crash. But today's discussion is, what do we do when the market crashes? All right. Nam says, would it be better to sell shorter dates to get premium more often while also reducing the black swan risk? It could be. Now, what Nam is referring to is I'm looking for the longer term ones because you generally get paid more premium to take that risk. And if I'm happy buying at that 220 example, I'm okay with that. Now, Nam, if you were to go out and let's say instead of using the September, maybe you did a weekly option for 220, you're going to get almost nothing for premium. So you're actually start to eat away with that a bit of your commissions. So I think it's kind of find that happy medium. If you're afraid of the black swan event, that one-off event that drops the market, you know, the S&P 500 points in a day, which would be a black swan, those things could happen. And if that's something that you're fearful about, then certainly you could go to shorter expiration dates, but remember, you're not going to get as much premium for those. Great questions out there, guys. All right, let's go to one of my personal favorites, and this is probably where I will focus my attention because of my personality type. I'm more aggressive. I believe that there's great opportunity to the downside, and I love shorting. I actually prefer shorting. I love panic. I love when I see charts just going straight down. I love it. Why? Because markets move faster to the downside than they move to the upside. There's panic and then there's streets. It's opportunity. So we can revisit this chart here, and of course you guys can see the amount of time that it takes to move up is normally much longer than the time it takes to move down. And you can see really in the middle of your screen where it rallied 104% from 2002 to 2008. That was 6 years to rally 104%. We gave that back, all of it, and then some in a period of a year and a half. So definitely moving much, much faster there. So the question becomes, which route do we go? How do we choose to go to the downside, meaning looking to go short? We could look at stocks, we could look at exchange-traded funds, we could look at futures, and we could look at options. Now, I know we have a lot of people who are familiar with the subject matter, so I won't go into much depth on all of these, but I'm going to start with this one right here, which is stocks. Now, I know some of you probably think, well, XYZ stock, it's been way too strong, it's got to go down. I'm not a believer in that type of thing. With this type of event, when I'm looking at the market collapsing and the market selling off, which is what I'm anticipating happening at some point, I don't want to go out there and cherry pick an individual stock. Yes, it might fall faster than the market, but I don't want to take that risk. So I just put this image on here kind of to be humorous in the needle in the haystack, right? I feel that if you're trying to find that one stock that's going to sell off more than the market, you're taking a bit too much risk out there. So I'm not going to really address this one. Yes, you could pick your stock that you think is going to go down more and you could short it. But I think that if we look at things that are more of a basket, like exchange-traded funds, then that helps spread our risk around a little bit. I want to make sure I capitalize on the downside move. I'm not necessarily trying to beat the performance of the market as it drops. Let me give an example. If the market moves up 10% and you got 10% of it, you're like, okay, I made market returns. I am constantly trying to beat the market to the upside. So if the market made 10% and I made 10, I'm like, okay. If I made 15%, all right, pat on the back, Merlin, you beat the market. You did something right. And it takes, to me, a skill set to do that. If the market drops 10% and my account stays at 0 and doesn't move at all, that's a victory. I'm not trying to make my account move 11% in that time. So it's a little bit different mindset for me. So I'm not trying to beat the market when it sells off. If it drops 40% and I capture 20%, awesome. I made money when things fell and 90% of the investing population is losing their shirts. That's a victory in my book. So let's look at exchange-traded funds. So here's an example, and I know for some of you that might be new to trading, this is like a spaghetti mess over here. When we look at things like the S&P 500, we have a reference to the overall market, right? That's a snapshot of pretty much everything out there. What I've done here is I've simply broken it apart into, I think I have 9 different sectors or maybe 10 on this. And to me, this one's pretty important because we want to make sure we look at the markets and say, okay, if I feel like I can beat the market and I know my core strategy, I know my rules, my discipline, my money management, then I'm going to start to take apart the market. And if you don't feel comfortable with that, then just stick with the S&P or the NASDAQ or the Dow or the Russell, one of those major market indexes. But if you feel like you can, your analysis is good, you know sector rotation models, and you know that type of probability, notice here I've got a whole bunch of lines, and you can see on the top, I'm colorblind, so I apologize, but the top line there is semiconductors. Semiconductors have been the best performer by far since 2017. And you can see on the left side, I've anchored all of these ETFs. Each of these is an exchange-traded fund, which represents a section, a segment, or a sector of the market. And you can see we've got XLF. You got financials in the S&P are pretty much the same, right around 16%. But you've got 42% for semiconductors, 32% up for technology, and down here you've got the lowly energy, which is just a nothing, down almost 12%. The point I'm trying to make is when these markets do roll over, and again, I will emphasize when they do roll over, some of these will have far greater declines than the overall market. So instead of trying to pick a specific stock, I would focus on something like this and look to see which sector is going to start underperforming. If the S&P drops 10% and one of these is down 15, that's the one that I want to be in. I want to be in the weakest sector possible when these markets roll over. Now, this is just a comparison chart, something that I like to use in my analysis to find out the strengths and weaknesses of different sectors. You could also use readily available retail sites. This is from FinViz. This is just a map of the ETF market. And what's great about this is it allows us to look at different sectors, kind of like I was just looking at. You have XLV there as healthcare. Okay, well, if we felt healthcare was going to be a gross underperformer, then we could go and we could short XLV or any of these. Now, as you're going through here and you decide to go short any of them, please look at volume. Liquidity is paramount here. If you're getting into something that doesn't have liquidity, you start to encounter some significant problems. Slippage. You won't be able to get out of the prices that you want, so make sure that it has liquidity. I like to look for at least 1.5 million shares traded per day. Of course, it really depends on how much you are trading yourselves. If you find yourself trading 1 million shares of something, you probably want more than 1.5 million, right? That's why I generally like to stick with things like the SPY, the QQQ, the DIA, IWM. Those are the very liquid ones out there. But some of these, even though they're represented on the chart, have very low liquidity. Okay, I'm going to take it one step further, and now we can look at something that is very important, because for some of you, you might have a 401k, you might have a self-directed IRA, and in those accounts, in a cash account, you cannot go short. So if I wanted to go capitalize on the S&P selling off, I can't hit the sell short button on SPY in a retirement account. Can't do it. But I could buy something that is short, like SH. So SH is 1-to-1 opposite of the S&P. So if I felt the S&P was going to drop 5% over the next couple months, okay, I'll buy SH in my retirement account. So it's a way to circumvent the rules that they've established in these accounts. Now, I also want to show you an important thing with regards to time decay and also the power of exponential multipliers, what I'm trying to get to. So take a peek at this chart. What I did is I've mapped out SPY, and I tried to label them with the appropriate colors for you. But you can see the S&P 500 since 2017 up 15.4%. SSO is a 2x SPY, meaning it's supposed to give you about double the rate of return of the S&P, and you can see it's up 33%. So it's actually up more than double. Then you have UPRO is supposed to give you triple, and you can see it's actually up more than triple. Now, notice on the bottom, I've got 3 lines as well. SH is 1-to-1 negative, SDS is 2-to-1 negative, and SPXU is 3-to-1 negative. And they're not exactly that 1, 2, or 3x, but just showing you that you have the potential to invest in these inverse ones. Now, here are some of the more popular ones out there, and I wanted to do this because some people are confused about what the symbols are. These are negative ones, okay? So this is all inverse ETFs. So if you're looking at going short the Dow Jones, you could buy DOG. DOG is simply 1-to-1 opposite of the Dow Jones Industrial Average. You could buy DXD. If you bought DXD, you would be double short the Dow Jones Industrial Average, and SDOW would be triple short. So these are just some of the leveraged inverse ETFs out there. And again, I'm not a fan of the triples. I think it's dangerous for you guys, but I wanted to put them on there anyway just so you know what you're dealing with. The only time that I've held long term was in 2008. This goes back to when I was kicked off CNBC, when I said if we break 1260 in a big way, break out the bulldozers, we're going down in a big way. I was long SDS and QID, so I was only in the doubles. Of course, it would have been a much better year if I was in the triples, but I just felt it's too risky. And there's another factor here I want you guys to pay attention to, which is decay. So check this out. It took me a while to build this, and hopefully you guys can understand this example. Don't worry about all the numbers in this table. What I want you to focus on is the top line here. So let's say you started with an account size of $100,000. And above that, you see 8 different rates of return. That's 8 separate days. So let's say on day 1, it moves up 1%. Day 2, it moves up 2%. Day 3, it moves up 3%. Day 4, it drops 1%. Day 5, down 2. Day 6, down 3. Day 7, down 1. And on the final day, it's up 1.15%. SPY, or your original one that the benchmark is off of, notice it started at 100,000, it ends at 100,000. Shouldn't they all be back at 100,000? They should, but there's a factor here with the multipliers as well as some time decay. Notice that none of them are back to 100,000. And it might be easier to see if we put on a visual, so I made a graph for you, and I even put a little horizontal line here. That red line represents no change, right? It started with 100,000. Notice that only one is back to that line. So the point I'm trying to make is, the longer you hold these double and triple leverage ETFs, the more it's slowly eating away at your gains. So be very careful out there. If you find yourself buying SPXU because you think the S&P is going to tank big time and you're holding that for 6-8 months, you're losing money just from holding it, regardless of what happens in the market. It's a strange thing that you don't really hear too much about in the inverse ETF space. Yoga says, I'm an Ignite graduate from India. Welcome. My query is whether supply zones of monthly timeframes are planned, because base news and surface the monthly supply. Are they planned? Remember, supply and demand zones, I wouldn't call them necessarily planned. The whole goal of core strategy taught at Online Trading Academy is saying, let's look at an area of price. And does that area of price leave the footprints of an institution? No offense, but I don't really care if Firis and Christopher and Yoga and Nam and David and Steve, if your buying doesn't really interest me, because you're like me. You're a retail trader who's might buy 1,000 shares, maybe 5,000 shares or something. I want the guy who's buying 500,000 shares. That's the guy who's going to move the market. So to say that a supply zone or demand zone is planned, I don't know if that's the right choice. Remember, an institution has different objectives and reasons why they have chosen to buy at specific or sell at specific prices. All I'm concerned with is using the supply and demand methodology that we've developed and saying, does that spot on the chart hint or give me the probability of an institutional buyer there? That's really all I'm concerned with, because, look, you guys aren't going to move the market. I'm not going to move the market, but Goldman is, JP Morgan is, right? These guys have the big bucks. Hedge funds will. Let's find their footprints. That's really what we're looking for. All right, our next way here is to look at the futures markets. Now, I know many of you are probably futures traders as we speak, so you're probably already versed on this one. This is a great way to make money in the markets when they decline, also when they go up. Futures are a great trading vehicle, great asset class. So all I did here is I wanted to show you some of the different futures contracts and their different symbols. And for those that don't know, futures are a leveraged asset, right? So it's not as weak as something like stock. You're adding extra firepower. These ones here I'm showing you, the Dow, the S&P, the NASDAQ, the Russell, these are very, very liquid. And you're not going to have any problem going short out there, right? It's really no problem to be going short on any of these futures contracts. The problem with the futures contracts is there's generally a 3-month roll. What I mean by that is they have expiration times, and I have the different expiration dates out here right now. So currently the most active one being traded is our June. So right now, if you want to look at the S&P, it's the ESM 18. So those number signs there, the pound marks, are really the end year. So if you're, let's say this is next year where the market started to sell off and you want to trade the September contract of the S&P, you'd be on the ESU 19. But it really depends on that time and place when you decide to place these orders. Futures are a great choice, but you would have to kind of keep changing them every few months as price decline. Excuse me. Let me get to this last one and I'll get to Christopher's question. The last part here is just simply options, which I think is a phenomenal way to be making money. This is actually a question that came from Dazville earlier on in our chat, which he just says, buy puts. Yes. Now here's the problem with buying puts. For those that don't know, a put is basically a bet that the market's going to go down. A call is a bet that the market is going to go up. Now, the problem I have with puts is this. Well, I love them myself. But if the markets are crashing and the markets drop and they're dropping significantly and you're now going to buy puts, how expensive are they going to be? They're through the roof. Why? Because everybody wants puts. The key with options, at least from my perspective, is you want to be buying them when nobody else is buying them. So, a couple months back, we had some pretty nice markets, all-time highs put in, looked pretty weak. I did okay buying S&P puts because they were super cheap. If that market's falling, you're paying a lot of premium. Anybody who's going to be selling that wants a much bigger premium for that specific put option. So that's one of the big negatives out there with regards to options in a falling market like that, is it's going to be, overpriced. Now, I could talk at length about options here. There's so many different things we could talk about, but really the discussion today is how do we make money when market crashes, or what should we be doing when markets crash? So you see on this image here, you really have two different categories. You have puts and you have calls. Now, to make money outright when the markets fall, that's buying puts. So you could go out to that put column there and you could buy the respective put, strike price, and time frame that you're looking at, or expiration date that you're looking at. That is a much deeper conversation, certainly something that would be best in a classroom type environment, which we have at Online Trading Academy. But that is the easy way, is to buy a put. You could also sell a call. There's multiple ways to do that. You could sell a covered call, which means you own that specific security you're selling the call on. But basically, that's another bet that things are going to be going down. You could do a naked call, but that is a risky proposition out there. So options have probably the most flexibility out there with regards to how we trade these markets and how we make money to the downside. Buying puts is the simple, easy one. Just remember that if markets really start to tank, then those premiums are going to be very, very high. Christopher says, is there any strategy for Forex trading when the markets crash? Sure. There is generally, and this is why I didn't include it in this presentation, because everything works until it doesn't. Now, if you look at what been happening recently with the dollar versus the equity markets, it has not been performing as it has historically. It used to be pretty much an inverse relationship out there. Now, it's not as tight. So if the markets really start to sell off, certainly going long the dollar would be a normal good thing to do. But I'm not going to say anything in that park right now, because I think what is more important is you have to look at what's going on at that moment in time. We have a very different market right now with regards to interest rates, political administration, rule changes. So that dollar relationship is kind of broken, and the currency markets, they're not always going to be directly correlated. So you have some instruments that sell off with the U.S. markets. You'll have, if the equity markets sell off, you'll probably see the euro sell off with it, because the dollar is going to be rising. So you could go, short the euro, you could go long the dollar. There's a lot of different options out there, but again, I'm not going to go into that one in here. That's a much bigger envelope that doesn't have any clear actionable items. It really depends on the instrument that you're trading, which cross pair or which currency pair you're looking at. Ivan says, can we buy and sell options with registered accounts? Registered accounts, not sure what that term is, but for the U.S., you have to have a margin account to buy and sell options. So you'll immediately have an options or margin account there. You generally have to fill out some extra paperwork to be able to trade the options markets. If it's a retirement account, generally no. But, I have a retirement account at an online brokerage firm, and they let you trade just about everything. So it really depends on where you go. So I would say if you're looking at shorting in your IRA, your 401k, generally is with your employer. That's a different story, which I'll talk about in a second. But if you're looking at your IRA, yeah, you set it up at a firm that allows you to trade the options in that. If you're looking for your 401k program, most of you are stuck with just mutual funds. Some of you can actually go self-directed, but you have to talk to your HR department for that and see, hey, can I go self-directed here? Once you go self-directed, you can now be using options as opposed to just the mutual funds that they stick you in on a regular basis. So, about 40 minutes or so, but the bottom line here is this. These markets are going to sell off, period. We all agree. I think everybody in there should be typing, yes, I agree, it's going to sell off. I just don't know when. When that does happen, I hope that you all have a plan, at least maybe after this presentation, you go home and say, okay, when it happens, here's my action steps. I'm going to pull out the cash if the markets drop to this point. I'm going to do this. I'm going to start buying puts. Whatever the case may be, I wanted to give you a wide spectrum of choices here. First step is be prepared. I think step number 2 is almost counterintuitive. A lot of people are reactionary. I say be proactive. Start building your plan today, and maybe even start building a position based on your feeling or how strong you feel these markets are going to sell off here in the short term. If you look at the price charts this year, it's been looking weaker and weaker. We've been making lower highs. We've made the same lows. If we start making some new lows, we could see a nice downside move here, but that's all in the future. Nobody knows what's going to happen there. Bottom line is, have a plan. We talk about this whether you're trading options, futures, Forex, commodities, real estate. Doesn't matter what you're doing. Starting your own business, have a plan. These markets are going to crash. Please don't lose 50% of your account by sitting on your hands or panicking. The bottom line is, you have to control your future. So go out there, be proactive. If you'd like more information, about trading options, about trading futures, how to make Forex trades out there, you can go into tradingacademy.com. There's a lot of classes out there, physical brick and mortar around the world. We've got over 41 centers right now, physical classes. So that's tradingacademy.com. If you like more information, just kind of how these overall markets work, we've got a lot of great financial matters topics available at otacademy.com. So thank you guys so much for sending in all the questions and participating today. I appreciate it. It was pretty much what we thought was going to happen. We've got some good choices out there. I got last one here from Tadao, says it's all going to crash down. Start buying gold. Surprised he didn't throw Bitcoin in there just to make us all feel happy. All right, thank you guys so much. Thanks for joining us. Look forward to seeing you guys in our next presentation. If you want more information, again, check out tradingacademy.com or otacademy.com for more free videos. That'll do it. Take care, everybody.